Hey, Tim Arrowood here, People's Home Equity. I'm talking. That's right. We're already disappointed. We didn't bring the right food for Joey. Missy's not here. So I'll make this brief so that you all are not totally disappointed. So hopefully the food's good. Did you get out of my picture? This is Kids Day at True North. I love it. That's the reason I guess they love me. So what I was going to do, I was talking to Matt, trying to figure out something that might be some value to you all, and we talked a little bit about like doing some quick mortgage 101 class, and I'm realizing we got a mix of folks that, I think the fundamentals won't hurt to go over some of that. But so I'm curious, I like to start with what are you all seeing in the market right now? So is it picked up? Is it still slow? What are y'all seeing? Multiple offers? Yeah. Still seeing some. Okay, cool. So how about you? Mouthful, man. So you guys see, is it different on the Tennessee side, the Virginia side?
Well, I just lost at Saltville, Virginia, multiple offers.
Really?
So, yeah.
Oh my goodness. Wow. Okay.
Yeah, I had a resale contingency, so it was no surprise we missed out. But
Right.
it was, they had like 4 or 5 offers, yeah.
Wow. Hey, was it just that it wasn't, was just priced really right to begin with?
Yeah,
or?
it was.
Okay.
It was, came with 4 acres, and it was about 2,500 square feet for $295.
Oh, okay. Got it. Hello. There's plenty of food. Plenty of food. But you have to eat salad first. Plenty of food. Out here on time. Yeah. There are rules from others that I have. So cool. Well, just this week. I got one client that's under contract. He got $10,000 in seller pay closing costs, right? And it was a full price offer with $10,000 seller pays. And then I got another under contract, $50,000 over asking, and multiple offers. It's been a few months since I've seen a escalation clause, right? And it was all the way up to, I think they were asking $335 for the place, and they got it under contract for $385. So I thought I had it figured out. I thought, things are softening a little bit. So but I'm seeing some more seller pays and some more things sitting on the market a little bit longer. So I was going to talk a little bit about the boring part of mortgages. And again, most of you all are pretty familiar with this, but I have put these together before. This is just I've got one for everybody. This is a matrix of different loan products, but we've updated it for 2023 with new max loan amounts and things like that. So, and we've dropped some products and added some products. So, but in terms of I was thinking about the process, and I think most people use the same process, but in terms of qualifying somebody, I don't know how many here have been through the process. I know you guys. Have you been through the process? Buying a house, getting a mortgage yourself, personally? Yeah. Okay, cool. And you had? Have you? No, not yet. Almost. Okay. All right. Cool. So that when we talk to people about getting pre-qualified, the whole idea is that I break it down in a couple of different ways. I look at a pre-qualification, meaning that I've pulled somebody's credit, I've asked them questions. A pre-approval is I've pulled their credit, asked them questions, I have supporting documentation, I get them into underwriting. So I think that we will do as many as we can to get them fully underwritten, and that's delicate right there. So the viewer cannot see a young gentleman walking around the tripod gingerly. And then we also have a third stage for us, which is a closing guarantee, a $5,000 closing guarantee. So if they've been through that process, they're fully underwritten. And since I'm self-insured, I look at them and say, I'm willing to step out on this. If they've got a sale contingency, or they're going to save the money, I'm probably, for their down payment, I'm probably not going to extend that guarantee. But in terms of qualifying, I look at it like the three big things that we're looking for is cash, credit, income. So I'm looking, identifying, does somebody have any cash, or where's their money going to come from for their down payment or their closing costs and things like that. Second part is credit score. We're looking for credit scores, looking for also what are minimum monthly payments. And these things are probably pretty obvious, but and then income. And usually the thing that we struggle with most is figuring out people's income. So whenever I look at getting somebody to underwriting, I'm usually looking at getting the underwriter's final word on what the income looks like. Because it's easy to say I'm salary, I make $65,000 a year. That's pretty. 65,000 divided by 12 is pretty straightforward. Then you get, I also get bonuses on top of that. So that gets a little bit more complicated. Then you get to, I'm self-employed. These crazy realtors, their incomes are a little difficult sometimes to calculate. And then if, there's salespeople in general that, so it just takes a little digging to make sure we get that right. So that's when we're looking at getting somebody through underwriting. To preliminarily, we're looking for we're really looking to identify what that income looks like. Sometimes there's things about, I'm not sure about the asset, trying to get that cleaned up, but it's usually pretty clean. They've got a 401k, or they've got, somebody's got mattress money. So I'm sure you've never had anybody with mattress money. It's like, yes, I know you've got $5,000 under your mattress, but first of all, don't tell me that. I don't want to know, because if you get somebody breaks in your house tonight, you're going to know I'm the last person you told that I've got money under my mattress. Okay, so but trying to make sure that money has seasoned for a certain period of time. Come on in. Or, Joey's got extra if you need any extra food. He brought his own. Yeah. So. So have you ever had anybody that happened to have money under the mattress, or cash that they couldn't use? So those are all fun things, and our job is to coach people through that. It's like, okay, well, the best thing to do is put that money in the bank, and let's just wait 60 days to let that money season. So, and when we're looking at that, we're looking at, it's legal tender. Why shouldn't I be able to use that money for my down payment? Well, we're looking at it from the standpoint of large deposits that maybe have come into their bank account, and we don't care if they're selling drugs. We care if they've gone out and they've borrowed money to borrow more money. So if somebody has borrowed $15,000, they put it in their account, then the reason for the 60 days is because usually over the course of 30 to 45 days, if they have borrowed money from any institution, it's probably going to show up on a credit report. So if it's been 60 days, we have a bank statement that says beginning, 60 days ago there was a beginning balance of X number of dollars. We don't care that it was deposited the day before. So that's generally what we're looking at for the asset side of it. Then income we've talked about. Self-employed or the most difficult really is just commission income, and we're looking for trends. It's very common to have somebody that's, I've worked at Coca-Cola for years doing this job. They just changed the job to be commission. I'm making more than I've ever made, but the base went from this much to this much with a lot of commission, and we just don't have enough data points to be able to extrapolate what you really are making. Because it may be that you have a few good months, you just get into selling cars. Hey, 3 great months. Well, is that going to continue? We just don't have enough time to be able to tell how long. So having preferably 12 months of history to be able to look at. But generally, we can look at taking somebody's income from 12 months. Now we would have to discount it. So we're going to divide, instead of dividing 12 months by 12 months, we would divide 12 months by 24 months. So we were going to discount what they're making. So those are all things we need to look at. You all don't need to worry about that, other than keeping in mind that there's a lot that goes into the pre-qualification. So, and that's one of the things. I'll pass these out. What I've done is I put this together. Now this is our products. I mean, there are other products out there, but when we're looking at, our job is to look at Well, our job is to do the due diligence to make sure we're turning you loose to look at properties and not waste your time. I mean, I think that's the key. You know, we don't want to say no when it's yes, but we don't want to say yes when it's no. And so when I'm looking at qualifying somebody, I've got people on the extremes that are easy, right? You don't have any income, you don't have any money, and you just came out of a bankruptcy. The answer is an easy no. And then the easy yes is like, well, I could pay for the house myself out of cash, but I want to get a mortgage, and I've worked at Eastman for 30 years, and my debt to income ratios are low. It's like, you pay anything you want. So what happens is we got as we approach the part where it flips from a yes to a no, that's where it becomes hard. So I can qualify somebody for, oh, you're well qualified for a $200,000 place, but we really want a $250,000 place. Well, it might work. So we start looking at, specifics and explaining to the client about property taxes. Well, it depends on what you find, where you find it, and it's going to flip from a yes to a no because you told me that you're looking in the county, now you're in the city, and you bought a place that's new and the taxes are fresh, or you got a place that was flipped, and the taxes are $800 a year, but once they adjust, they're going to be, $1,600 a year. Those types of things go into it. So let me think. So in terms of assets, we're looking at credit score. We can go down to 580 credit score. I've done an FHA with a 550 credit score before, but it had 10% down. So it really just depends on what's going on. There's a lot of factors that go into that. We have the ability to do a manual underwrite. We've got a deal right now with, hopefully a deal with Lincoln, and a veteran buddy of his that is, he came to us and his score was in the mid fives. We told him to tweak a few things. Within 30 days, his score had come up about 60 points.
Yeah.
And it was in the mid 600s, which you would think that with a VA loan, there's a lot of positives there, but it was what we call refer eligible. So we like to see a approve eligible, which means the software that we use says, yeah, you can do this, and we don't have to go in really deep into the documentation. If it's a refer, that's a manual underwrite. So what we did is we have already been through underwriting with that, and we got an okay from underwriting that says, yeah, they're a manual underwrite, but we're good. We didn't just wait and say, well, we think it'll work. Get under contract, and then we'll just see when you're under contract. So we've already been through that process. There are others that won't. Like, for example, this is one where at one point he was trying to buy a D.R. Horton house, right? So they really, really push to use their in-house lending, which is fine. We really can't. If they fit in their box, no other lender is really going to be able to help because they offer them the sell at the closing costs. They provide. There's a lot of different things, but we get a number of fallouts from DHI, their mortgage people, because they just don't. I look at it like this: there's a box that is what the guidelines say that you can do, and then our companies will have overlays. So if you can fit something in that box, well, if there's an overlay that's just a little bit smaller, then like for example, VA says, yeah, you can do manual underwrites, you can do high debt to income ratios, you can do low credit scores, but some people would say we don't go below a 600 credit score, or we don't do above a 60% debt to income ratio. And we can do those as long as we get an approve eligible. So what will happen is that some other people would say, well, we can't do that, or it can't be done. Well, it may not be able to be done, but we would run it through, and if it says okay, we'll do it. So in this case, it may be that we could do the manual underwrite, but D.R. Horton's mortgage people wouldn't. We're not really sure yet. But it's been.
They haven't quite got the yay or nay yet. But
yeah.
I don't think they are.
Yeah. So, and it's actually pretty common. It's a great deal if they. I hate to lose a deal, but because of the way they've structured it,
Right.
it's if it's best for the buyer, it's best for the buyer, right? So, so in terms of credit scores, we're looking at things like, well, you don't qualify the way you are, but you have cash. What if we paid this down? What if we paid that down? And that's our job to look at. We're not expecting you all to get in that deep. You don't have the tools, and it's just you just don't need to get in there. So I'm trying to think of income, cash, credit. And obviously the property itself, the collateral. So, there's things that we know about, some things we don't. We lean on you all to say, yeah, will this go FHA? Because many times I have no idea, right? I've not seen a house. So that's where we lean on you all. But I don't know. It seems like most of y'all have been through the process and kind of know what's going on. But any questions about qualifying or how we do stuff, or anything about any particular specific
Can you
scenarios?
just touch base on your $5,000 post-cost guarantee?
Sure. So the way it works is that after they've been through underwriting, and I look at it, and typically I'll do a VA, a conventional, or FHA. I won't do and again, this is not like corporate says we do this. Tim has, I'm self-insured, so I've got money set aside. So if I say that it will work, they get under contract and it doesn't close because of something that we did, we missed seeing something, or we just didn't ask the right questions. Now if they go and they buy a boat when we told them not to buy a boat, or they spend all their money when they weren't supposed to spend all their money, then I'm like, I can't control that. But if it doesn't close because of something I've done, I'm gonna write a check. I'll write 2 checks. One, I'm gonna write a check to the borrower because I've misled them, right? They've spent money on appraisal, home inspections, and things like that. And I'm also gonna write a $4,000 check to the seller. They've taken their house off the market, and it is, now it appears to be damaged goods sometimes, right? Because you've taken off the market. What's wrong with it? Well, it wasn't, I see it all the time, but no fault of the seller, this fell through. I haven't had to pay out yet, right? Eventually we will. We do enough business, we're probably gonna make a mistake, But I would rather put my reputation's on the line every time anyway. But if I put my money on the line with it, then I feel like that when I make the call to the listing agent, and some of you will do this. I've got some clients that, or some agents that they'll just copy me on the offer that they made for a place. They'll copy me on the offer, and that's my trigger to call the listing agent saying, I just want to let you know these folks are A, pre-qualified, I did it, everything looks good, or B, they're pre-approved, they've already been through underwriting, or C, have you heard about my guarantee? And talk to them about that. What we're trying to do is, we're just trying to get the offer accepted, right? What can we do? Anything we can do to elevate that to where they get a second or third look. Had one over the weekend that, many times I know the listing agent, so I'm having a conversation with the listing agent, and they're like, when it comes down to it, I got an offer from Rocket, right? I got an offer from me with or without the closing guarantee. And having a conversation, and you all as listing agents are going to say, they're all good offers. Okay, which one's going to close with the least amount of hassle? That's the way I look at it, right? The seller may think differently, but it wasn't anything I did this weekend, but there was the house that I told you that was my clients got for 50 over asking. Somebody else had offered 70 over asking, but it was a VA loan, and they didn't have enough money to put in an appraisal contingency or appraisal gap, right? So my guys were putting 20% down, but we knew that if we needed to, we could go to 5% down and still have enough money to be able to cover that spread. So I think that it's again, in that case, I'd like to think that I'm the one that got it, but I think it was a combination of things. The agent did a great job of knowing what the seller wanted, and then putting together the offer and had an escalation clause, some other things. So, okay. See, I knew it was going to be hard to compete with all the kids today.
Yes, no, that answer.
That help?
Yeah.
Okay. So, anybody, I'm gonna.
What do you got for just generic credit scores for different loan types, as far as like bottom end? Thank you, sir.
Bottom end is typically 580 credit scores for.
Across the board, or?
So actually on this sheet is has got the. I'm glad you asked. So there's a line there that says minimum credit scores. So 580, 640, 580, 640, 620. What happens with a conventional loan with? You follow me? No, you know who I am.
They'll do jumbos with a 660?
What's that?
Jumbos with a 660?
Have
Yes.
these changed since the last time you've?
No, they change from time to time. Yeah. So it's if you have an old one, it'd probably be a good idea to get your hands full. So. Okay, so everybody got it. There you go.
Thank you.
So what ends up happening with conventional loans with low credit scores, it becomes so expensive that it's not real practical.
Why is that?
So typically with what we call gutties, the FHAs, USDA, those kind of things, they're guaranteed by the government, whether FHA does it or USDA. The conventional ones are all in the government loans tend to be the loan of last resort for some people, and because they're backed by the government, they're perceived as less risk by the lenders, and so the pricing is better. So what happens is if somebody's got a 620 credit score and they try to do we'll be glad to do a 20% down or even a 10%, but the mortgage insurance, the private mortgage insurance is really, really expensive, and so we tend to shuffle somebody over into an FHA loan. But if somebody's putting 50% down, they got a 620 credit score, then we can do that. It's just the pricing tends to be a little more expensive, so that the rate's not as good. So on this, let's see. So we talked max loan to value. We had another 100% financing option, and I just dropped it because it was so expensive and nobody ever used it. So, and if I was going to pick between getting 100% financing people and jumbo people, I'd go with the jumbo people. So, but let's see. Max household incomes, again, things that you all don't necessarily need to know about your clients, but you can see that if we look at THDA, for example, in where is it, Greene, Hawkins, and Johnson counties, you don't have to be a first-time homeowner. So which is kind of can be helpful. And we're looking at appraisal guidelines, most strict to least strict. The big one I think that's really helpful is just keep an ear out for bankruptcy and foreclosure. Like, VA, we can do 2 years on bankruptcy or foreclosure, but then you're looking at 7 years and 7 years on a jumbo, right? You're going to have that much money tied up with one particular loan. They're pretty particular, right? So, and then jumbo is going to be anything over the max conforming. So that's going to be max loan about 726,200. That's amazing. That's a conforming loan that I mean, when I got into business, it was probably 300, something like that. So there's not as much need for a jumbo, but still there's plenty of those. So.
Tim, with most of your first-time homeowners, what, general product do they use most from you if you have first-time homeowners?
Tends to be THDA is a good one in Tennessee. We have access to VHDA, but the last time I did one, VHDA, I vowed to not do it.
Virginia's and veterans.
It was Virginia, so it was a similar program to the THDA, but it was a second mortgage, and I just it wasn't a good experience for us or the borrower. So we said we probably just won't do this. Now, if you all said, "Hey, would you please do one?" We'll probably dust it off and say, "Give us 60 days, and everybody knows what you're getting into," and we would do one. But it's just, and maybe they've changed the way they do things, but it wasn't real. I don't know. It wasn't a real friendly product.
Have y'all messed with the, I can't even remember what you call them, the ones that you can tie in, remodel.
Yes. So so we could do a 203K.
203.
Yeah, 203K, and that's an FHA loan that you can roll in the repairs. There's also a conventional version of that. So we have access to those. We also do a one-time close construction. So if somebody's interested in doing that,
Like the land and.
yeah, the land and the house. And the hard part is getting everything together at that one time, right? I mean, as a builder, it's like, okay, typically you don't pick out a house plan until you find the lot, because the lot's gonna lay a certain way and you wanna pick it for this. I've been in discussions, and one of the things I was gonna do, I was trying to get one of the Clayton Home general managers, I was gonna have him come and speak, because, we can do some of those land home packages. And, I know that it's funny. Wait, I've probably said this before, but I was talking to the Clayton Home guy, and when he starts to talk smack about Dior Horton houses, that was just hilarious, because it's like what they call pot calling the trade breezy. Yeah. It's like, so, but I think there may be some opportunities. It's like, well, you've shown people properties, and you've run out of. Did you put a filter on that?
I was just saying, we're just getting a lot of hate comments on it.
Oh, okay.
Yeah, somebody comment Piedmont goes on.
So, and then on the back, there's several different things on here, but on the thing that renovation loans, non-QM, I don't know if you guys have run into know what that terminology is. QM is a qualified mortgage. It's what the conventional loans, FHA, all this stuff. And non-QM is not qualified mortgage. It's something that is, it doesn't fit in the qualified mortgage box, which the government created after the 2008 meltdown. So, for example, in the last 12 months, I've done a bank statement loan where a borrower, self-employed borrower, on their tax returns said they made $75,000 a year, but they'd written off a bunch of stuff. When we looked at their last 12 months of bank statements, the underwriter calculated they made $115,000 a month.
Who would do such a thing?
Who would do so? Write off so much? Yes. So they went from. I don't think you can buy everything to you might think you want. And so there's 12-month bank statement program, 24-month bank statement program, and we're just looking at the flow of money through their accounts. The other one is a DSCR, a debt service conversion ratio. It's an investor cash flow program. So if in a situation, we've talked to Joey and Matt about some of these where if you're looking to buy a property for investment and you own your primary residence, then we don't care if you make any money. We care that you have a good credit score, and we care that you have enough money to put money down on the house. We're going to order an appraisal. The appraisal needs to be, support the value, but we're also going to ask for a rent, we call a rent roll for it. It's going to say, well, the property should rent for $2,500 a month. Well, my payment, principal, interest, taxes, and insurance is at or less than $2,500 a month. We'll do that one. We don't care about if you have any income. And I did a friend of mine. He owns 4 or 5 businesses. He bought a lake house for like $1.4 million, and he's just used to having access to plenty of money. And so he says, I'm under contract on buying this house. I got 30 days. I'm like, oh, okay. And you're calling me now? After you're under contract? Of course. Yeah, that's the way we do stuff. And so I said, we have 2 paths. One's the least expensive is a conventional loan, but we're going to need year-to-date P&Ls. We're going to need banks that are tax returns from all these businesses. He owns 100% of the business. He said, it'll take me 3 months just to get my year-to-date P&Ls up to date. We don't have time. So we went over to, he was buying it as an investment property. So he just put 30% down. We didn't, if you're looking at the 3 legs of cash, credit, and income, we didn't even have the income leg. Right? So we just did it. What?
I was just laughing. Man, we just put 30% down.
Yeah. Well, it is kind of weird. When I first started out in the business, it's like my average loan amount was $115,000, right? And I'm scrapping for $70,000 deals, and then over time, both my clientele changed, but then the market changes, and then the older you get, many times the old guys got more money than the young guys. So I happen to ride that as it increased. But and the funny thing was, he said, I'm going to pay it off in 3 years anyway. It's like, oh, cool, yeah. So $1 million $1.3 million, I think it
What's
was.
his number?
Wow.
So, but those are, our job is to be creative and try to figure out how to make something work. I've got one right now that's, he's Canadian, he's not a U.S. citizen, and he's trying to buy a single family. Nobody will touch him. He didn't have a U.S. Credit score, he didn't have anything. And so, I've found a non-QM lender that would be willing to do a primary residence for a foreign national. So, I'm talking to him, he's from Canada. I got another guy that's from South Africa that's looking to buy some investment property. So, those are like, the rates are gonna be more expensive than what you're gonna see for conventional loans and things like that. But if the last resource, right? So they don't mind if they pay 8.5%, something like that, which is actually not that bad these days. So we talked about construction loans. So anyway, this might be helpful. A lot of people enjoy having those. And then for those of you that, I think I've probably given you one before these. We've, in an attempt to try to make sure we don't miss any leads that will come through on nights and weekends and all that stuff, we put together the Hot Lead Hotline. And I had my trusty graphic designer from the Philippines put this together for us. It's a big guy, yes, actually. Cool. So, what's his name? $30. He'll make anything look pretty. Who are you eating? He's cut off. There. So I mean,
I hope you don't even move.
so the idea is. So the idea is that there's that one number, the 423-406-1567. We're using a system that we can use to manage our texting. So if you were to send a text to that number, then I get it, Paul gets it, and Misty gets it. And so 24/7. Did I still not give you one of those?
No, I didn't have one, so I didn't have one.
So
Lincoln's being nice today.
Unlike
Tim.
No food, no pamphlet.
That's right.
Unlike Tim, he's being mean today.
So, we just, like, this came to light when I went on vacation last year, and I was gone for a week, and I got a lot of people that had my cell number, which is great. I appreciate any lead, but I'm afraid that I'm not gonna see it, right? Or we're gonna be busy, and so we've got 3 people looking at it. So when it comes in, our goal is within 30 minutes, we're gonna reach out to it. That's cool. And so, when I'm here talking to you all, lead comes in, somebody else is gonna cover it. So, and this is just, the idea is red, yellow, green, making sure that you don't waste your time. So that's all I got. That and food today. So
Thank you.
thanks for having me.